Welcome to Chartered Accountant's Pen. In today's lecture, we will explore IAS 19 employee benefits. We'll cover the core principles, classifications, practical examples, and disclosure requirements. Let's begin. IAS 19 is the international accounting standard that deals with employee benefits. It sets out rules for recognizing, measuring, and disclosing all types of benefits employees receive in exchange for their services. Employee benefits are classified into four categories. Short-term benefits include salaries and bonuses. Post-employment benefits cover pensions and gratuity. Other long-term benefits include long service leave, while termination benefits arise from contract terminations or restructuring. Short-term benefits are recognized as expenses when the employee renders the service. For example, monthly salaries, bonuses payable within 12 months, and paid leaves fall under this category. A defined contribution plan is straightforward. The employer pays a fixed amount into a fund, like a provident fund. Once the contribution is made, the employer has no further obligation. The expense is recognized in the income statement. A defined benefit plan is more complex. The employer promises a future benefit, such as gratuity, based on years of service and salary. The liability is measured using actuarial assumptions such as discount rate, mortality, and employee turnover. Accounting for a defined benefit plan involves calculating the present value of the obligation and subtracting the fair value of any plan assets. The difference is either a liability or an asset. Service cost and interest cost form part of the profit or loss. Let's take a practical example. An employee is entitled to a gratuity of 1 month's salary per year of service. After 20 years, and with a monthly salary of 100,000 rupees, the present value of the obligation, discounted at 9%, is around 2 million rupees. Plan assets are funds legally separated from the employer and held in a trust. These assets are used solely to pay employee benefits. For example, gratuity trusts or qualifying insurance policies. IAS 19 introduces an asset ceiling rule. If a surplus from plan assets cannot be refunded or used to reduce future contributions, it cannot be recognized as an asset in the financial statements. Disclosures are extensive. Entities must provide reconciliations of obligations and plan assets, actuarial assumptions, sensitivity analyses, and risks associated with the plan. This promotes transparency for users of financial statements. Let's compare IAS 19 with US GAAP, or ASC 715. While both deal with employee benefits, key differences exist. For example, under IAS 19, actuarial gains and losses are permanently recognized in other comprehensive income. In contrast, US GAAP allows amortization of these gains and losses through profit or loss using the corridor method. IAS 19 requires a net presentation of the obligation and assets, while US GAAP may report them separately. Finally, disclosures under IAS 19 require sensitivity analysis, which is not mandatory under US GAAP. In summary, IAS 19 provides a framework for recognizing and disclosing employee benefits. Understanding the nature of the plan and the required disclosures is vital for accurate financial reporting. Thank you for watching Chartered Accountant's Pen. Please subscribe, like, share and hit the bell icon for future videos.